Welcome to Chapter 10 in Principles of Accounting 1. Chapter 6 through 8, we talked about short-term assets. In Chapter 9, we talked about long-term assets. In Chapter 10, we change course and start talking about liabilities. So liabilities are, of course, the things that we owe people. So we owe them for accounts payable, or a loan payable, or other very things. But in general, it's just that we owe other people money. So what's the difference between debt and equity financing? Well, debt financing is taking a loan from the bank. Equity financing is selling shares of stock for cash. So when we have liabilities, they come due at different times and they have to be paid. Our bank wants to be paid on a very regular basis. We also have interest payments. However, on owner's equity, we don't have to pay our shareholders anything. As we see when we get into chapter 11 and 12, we'll see that some companies do pay their shareholders in the form of dividends. But it's not required, they don't mature, and we don't have interest payments on stock. So another thing about liabilities is that if for some reason a company would go bankrupt, that liabilities have first priority over any funds that the company possibly has. So stockholders are actually at the end of that list. If a company goes bankrupt, any money that they have available at the time of bankruptcy goes to creditors first. As I said before, many liabilities require the borrower to pay interest. We've talked about interest calculations in other chapters, and our obligation to pay interest is often disclosed in the notes to the financial statements. It's not an existing liability, but many people who are reading our financial statements understand that if we have long-term and short-term debt, that we have a responsibility to pay interest as part of that debt. We have many estimated liabilities. So some of those examples include notes payable, accounts payable, accrued expenses, interest payable, and salaries payable. We also have, if our estimated liabilities have two basic characteristics. One, that we know the liability exists, and two, we can't determine the precise dollar amount until a later date. So some of these things would be like a warranty liability, like this talks about in this example. So if we sell something with a warranty, we don't know whether or not customers are going to come collect against that warranty. So what we do is we estimate that a certain percentage of customers are going to collect on that warranty, much like we would estimate what our accounts receivable, that we have a certain number of customers that won't pay for their accounts. So we have to use good practices, historic information that we have to guess what those liabilities might account for. So we also have current and long-term liabilities. These follow the same rules as current and long-term assets. Current liabilities are expected to be paid within 1 year or the operating cycle, and they're paid from current assets. Long-term liabilities are anything that are on our books for longer than 1 year or a current operating cycle, whichever is longer. Many examples of our current liabilities are included here. We're going to talk about a few of them step by step, but accounts payable, which we've already seen in several other chapters, short-term notes payable, which is a note that would be due less than a year from now. The current portion of long-term debt, this means that we have long-term debt such as a building loan, which are generally for 15 to 30 years, that it's the amount that's due within the next year. So that's the current portion of long-term debt. So if we have a 30-year loan, we would have the current portion, which is what is due within the next 12 months, and then the long-term portion that is sitting on there for the next 29 years. We have accrued liabilities. These are interest, income taxes, and payroll liabilities. And then we also have unearned revenue, which again we've seen in previous chapters. So accounts payable often get divided into two different categories. Our trade accounts payable are our supplier accounts. So if we're a merchandiser, we're buying inventory from suppliers. So we will keep those in a separate subsidiary ledger from our other accounts payable. Other accounts payable could include anything from our people that we order from supplies from, to people that we get services from, etc. So the first thing we're going to talk about is notes payable. Well, notes payable are issued when bank loans are obtained. Many of those things require something that's very expensive, something that we don't have the cash on hand for, such as the purchase of real estate or expensive equipment. So normally we pay an interest charge on notes payable, and notes can run anywhere from 60 days, as we've seen in some of our examples in previous chapters, to 30 years, which is what a typical real estate mortgage loan is. So in this example, we have borrowed $10,000 from our bank for a period of 6 months at an annual interest rate of 6%. 6 months later, on May 1st, we'll have to pay the bank the principal amount of $10,000 plus our interest expense. So if we remember that interest is the amount of the loan times our percentage rate of interest times the time of the loan. In this case, it's 6 months, so we have 6 divided by 12. When we receive this loan, we get a notes payable, such as this promissory note that is shown on this screen. We have to sign that, yes, we recognize we took out a loan for $10,000. It has a 6% interest rate. We have to pay it back in 6 months. So a promissory note is something that we sign that we're acknowledging the loan. When we're looking at that example, the journal entries that we would have for that example are when we receive that note, we would receive cash for $10,000. We would also receive a note payable for $10,000. Then when we recorded our interest expense, we would have an interest expense of $100 and interest payable for $100. At the time that that note becomes due at the end of 6 months, we will have a note payable that we pay off $10,000, interest payable, which we recorded for $100, an additional interest expense of $200, and we would pay cash for the total amount of $10,300. When we switch to the next example, we borrow $160,000 cash by signing a 90-day 8% note payable with a face value of $160,000. When we want to compute the accrued interest payable on December 31st, and then prepare the journal entry to record this interest. The first thing that we need to determine is how many days is it between November 7th and December 31st. So if you remember when we talked in class about counting on your knuckles, that every month that is on your knuckle has 31 days, and every month that is in between your knuckles is 30 days, we would calculate that November has 30 days. And so from November 7th to December 31st, 54 days pass. So if we take 54 days, forgive my handwriting on this, 54 days, and we want to calculate interest on that 54 days. We would take our 8% rate times the $160,000 loan. Okay, this is almost better than I do on the whiteboard sometimes, right? Times our time, which is 54 days. For this example, we're going to divide by 360. So remember that your homework will tell you how many days you should divide by. So we take 8% times 160,000 times 54 divided by 360. That gives us an accrued interest payable on December 31st of $1,920. The journal entry to record that accrued interest on December 31st then is a debit to interest expense and a credit to interest payable. Then when we pay off this loan, it is going to be much like when we paid off the other loan. We're going to have a journal entry where we have an interest expense. So this interest expense is for the remaining interest that we did not already accrue as of December 31st. We have interest payable. That is the interest that we just accrued between November 7th and December 31st, the $1,920. We have our note payable for $160,000. And then we pay cash of $163,200 to record the payment on that note.